Hi, good to be speaking with you. Let's start by the auto sector, right? This EV transition that everybody has been talking about, it's not entirely a new theme. It is something which is well discovered. We know about it and we all know, and the consensus seems to be that it is the future. Do you think the best way to play it perhaps through these battery makers and other ancillaries as well, or do you think there is any of those auto OEM manufacturer which stands to perhaps gain the most in the entire EV race?
So it's a very interesting question. EV is not new. There are 2 or 3 ways to play EV. First is the ER&D names. You've got a couple of names in the IT sector where you can play the overall EV story, be it KPIT, a little bit of it coming in Access CAD, a little bit of it coming in Persistent, a little bit of it coming even in companies like Cyient. The second way to play it is the chemical ways, wherein you have companies like Tatva Chintan, which will be a big EV producer, especially for hybrid cars and then electrolysis in the future. The third way is the OEMs. If you look at companies like Tata Motors, they again own either directly under them 100% or 80% of companies which are invested into doing EV, or they own Tata Technologies, which again gets a lot of its bread and butter from the EV story. What's important here is if you're looking at an ancillary, look at the return on capital employed the ancillary will give you in the overall scheme of things and how much time it will give you to make a difference in its earnings. We come from the school of thought it's better to buy the first 3, which is the IT names or the OEMs or even the chemical names over pure ancillary names.
Point taken. So that's the distinction that you're making in this entire EV theme. But what about IT sector as a whole? Now I ask that question because there are initial signs that things have bottomed out, whether it is the fact that TCS has started or resumed the campus hiring again, or the numbers coming in from InfoEdge's making you believe that perhaps hiring is picking up. And of course, deal wins were as it is strong for these companies. There wasn't a big lull in deal wins. Do you think this, as in Q4, will perhaps be the worst of the quarter, and from Q1 onwards there will be material improvement, or do you think it's still some time away for the IT sector?
I come from the thought of the latter. Our analyst believes, if you look at the interest rate curve, which tells you where the order book would come of US, it's moved up for 10 years from 4.1 or 4 to about 4.47 to 4.5%. Basically means, interest rates are in the high for long regime. Step 2 of that would be, you would see IT companies globally reducing their order sizing in the future. And you'll probably hear a lot of that in this quarter's results or next. So are the stocks close to the bottom, the large caps? I think so. But I seem to see triggers in the next 3 to 6 months for them. So here, IT, if in the traditional IT names, we would be underweight as of now. Are we looking at them? Yes, we are, but we are in no hurry to buy them. We are doing it largely by the ER&D names, the IT sector.
Okay, so not in a hurry to jump into the IT bandwagon as yet. There would be perhaps better opportunities available. But I also wanted to get a sense from you regarding this entire real estate boom that we are seeing. And, for the last 6 months, the worry has been, when will that bubble burst? Is it already plateaued? But if you look at the demand coming in terms of consumer durables as well, in terms of the other building materials as well, it continues to be quite high. Again, what's the best way to play the real estate boom that we are seeing?
The single biggest name which comes into my eyes is basically the housing loan companies. Be it there are tons of names in the financial sector you can play real estate boom. A, the yields are better. B, they're as good as secured loans. C, these companies have their costs, or I would say their deposits, which they've got at relatively high rates. If you look at results of companies coming like Chola, you're looking order book, the loan book grown north of 65% on a yearly basis. Even on a QOQ basis, you're seeing 15 to 17%. So good numbers coming up. You can play it any of the ways. We are happy playing it through the NBFC space.
NBFC, I also see you're quite bullish on the Capex cycle, and you are playing it not only through capital, but you're also playing it through the defense theme. So Bharat Electronics and Hindustan Aeronautics are the 2 names that I see in your list. Could you talk to us a bit more about rationale here and the longevity that you are looking at holding these stocks for?
Sometimes our analyst Mukund feels, they're looking at consumer names when we talk about defense, because one thing which is increasing on a year-on-year basis is the expenditure in defense. If you look at the last 10 to 11 years, the overall defense expenditure has gone up north of 2 times. But what's more interesting is the domestic names, be it Bharat Electronics, be it Hindustan Aeronautics, their part of the business has gone up by more than 3 to 4 fold. Currently, today, you have more than a 4 times book to sales where each of these companies have. Hindustan Aeronautics, interestingly, on its manufacturing part, has more than 8 to 9 years of an order book, which means you've got good longevity for their earnings to come up. Typically, the export cycle has still not started. In the case of Hindustan Aeronautics, it's 1%. In case of Bharat Electronics, I think it's about 9 to 10%. These numbers are set to increase substantially, and that gain India and more importantly the Indian defense companies as well. Today you're playing the defense name more with the Atmanirbhar concept, which is instead of depending on the rest of the world for your defense equipment, you're buying it from these companies. In the future, they would become bigger export houses than one can imagine. So we really like these names.
This renaissance, perhaps it's the time of manufacturing renaissance, and that's why perhaps likely to become an export hub when it comes to defense as well. But I also see hotels in your list. What makes you tilt towards that and not say like an Indian hotel or even Chalet Lemon Tree?
Purely valuations. So whichever name you would look at in the house, in the hotel industry, all of them gain for extremely high productivity today. They're all super efficient. You're seeing the average rentals per room on a daily basis literally going up. Sami on one side has somewhere close to 7,000-8,000. Indian hotels are somewhere close to 18 to 20,000. Chalet is between the two. So the rate of growth, if you start seeing the pricing power of the hotel industry inch up, would be more Sami. Being more a levered play, this company has grown both its rooms, but as its cash flows improve, interest costs would also further go down. So you would see an EBITDA growth, more importantly, net profit growth much faster than the other peers. But the hotel industry, I think the earnings growth will be equal to largely the quality of rooms get in, and whoever has the highest hotel room growth, I think that company would be looked very well as far as the bosses are concerned.
That does make sense, but I also want to know your view regarding BSC. I mean, if I have it right, the stock has become 4x in the last 12 to 18 months. How much further do you think it has the rooms to actually rally?
So our analyst Pooja has raised numbers multiple times on BSC in the last couple of quarters. Currently, she expects a 40 to 45% growth in earnings for the next 2 years. And even on that, on her numbers in the option market, the market share would be about lower than 20%. Now, typically, if it's an oligopolistic market, you cannot have an 80-20. Today, obviously, 90-10 market share overall in any of the markets, especially if the products are very similar. So I think BSE has a long run to gain in terms of revenues and earnings, which are growing north of 40%, can inch up. And when seeing such high quality earning growth, a peg of one, which means a 40 times multiple is very possible. So we're pretty excited about this.
Okay, since we're talking about earnings and valuations, I just want a macro view from you, Vinay, in terms of Indian market itself. I mean, FY24 itself, almost 30% return on the Nifty, 70% on small cap. Valuations are no longer comfortable. We are very close to that 5-year average or a little higher than that. What do you think is a realistic expectation? Because at one point of time, obviously, you've all the investors and experts talking about the big theme of Amrit Kal and the long-term, upside that is there in India. But realistically, do you think we have the wheels in place to kind of repeat the 2024 or FY2024 performance?
I don't think so. Having said that, will there be an absolute return on the market from current levels? I'm pretty confident there. There are more technical parameters to run that argument of ours. I'll run you through a couple of them. First, India's overall weightage in FII has gone down from a peak of north of 20% to about 16.5%. It's at an 11-year low. Second, you've seen India included in a couple of emerging market bond indexes, be it JP Morgan or be it Bloomberg. So you'll see a lot of money coming in from there. Third, when you're looking at India's economic growth compared to the rest of the world, today we are incrementally adding about 15% of the world's GDP. We are about accounting for about 1.5 to 1.6% of the profit pool. or what weightage one puts in as far as indices are concerned. I think all these things are set to move up, which means the importance of India is only increasing. Fourth, if you look at the corporate capex spend, that's still not happened. We did speak about capex a little bit, which we are excited about, but all the capex is largely being funded by the government. The government has had a CAGR of capex spend of about 30+% in the last 3 years. Once corporate capex starts increasing, you'll see a lot of projects and you'll see a lot more profitability come in corporate India. Today, corporate India's profits, give or take change, are about 5% of its GDP. Can that number go to 10, which is very similar to what US is today, in the longer term? Probably the answer is yes, but you need to start seeing corporate capex growth. And finally, earnings. We are just getting into the earnings quarterly results. You've heard about consumer names. You've started hearing about jewelry names. But if you move on towards corporate earnings, now it's not about just finance, which was growing historically. Though 30% of the overall indices, financials were growing very well in the past. Last quarter, you saw them grow at 20, but you saw many other industries, be it industrials, be it telecoms, be it auto, grow way north of 20%, and you had a broad-based growth. I think that's where India is heading towards, huge earnings growth. So keeping all these things in mind, I think the earnings trajectory of India could be north of 15%. Obviously, elections, geopolitical risk are some things we need to access. But if things go India's way, an absolute 15% return on a 12-month basis cannot be ruled out.
At least a 15% kind of return cannot be ruled out. That's the word coming in. Vinay, thank you so much for making time and speaking with ET Now. Appreciate your time today.
Thank you.
Okay, on that note,
if you like this video, then like, share and subscribe to ET Now.